In year one of a typical mortgage, 72 cents of every dollar you send the bank vanishes into interest and property taxes, not equity. Renting isn't the only payment that disappears into thin air. For decades, the American Dream script said, pay rent and you're throwing money away, buy a house and you're building wealth. That framing treats homeownership like a virtue and renting like a mistake. But the financial system doesn't care about virtue. It cares about returns, timelines, and what else you could have done with a six-figure pile of cash. The rent versus buy decision exists because housing serves two incompatible jobs at once. It's shelter you need today and an investment that might pay off years from now. Those two roles don't always cooperate. Understanding whether buying beats renting in your specific situation requires looking at three mechanics the feel-good narratives ignore: opportunity cost, cap rate, and time horizon. Opportunity cost means every dollar you spend on option A is a dollar you can't spend on option B. Money isn't infinite, so choosing one path automatically closes another. If you put $60,000 into a down payment, that $60,000 can't simultaneously sit in a stock index fund. $1, one job. The cost isn't the money leaving your account, it's the other future you gave up. Cap rate, short for capitalization rate, is investor speak for what annual return does this asset generate before I touch it. It's calculated by taking the yearly income a property could produce, dividing by the property's purchase price, and converting to a percentage. A rental house that could collect $24,000 in annual rent and costs $600,000 to buy has a 4% cap rate. Cap rate reveals whether real estate competes with other investments like bonds or index funds. Think of it as the interest rate your house pays you for locking your money inside it. Time horizon is how many years you'll actually hold the asset before selling. A stock you flip in 6 months plays by different math than one you hold for 20 years. Same with houses. Transaction costs, equity accumulation speed, and compound growth all hinge on duration. Start with opportunity cost, because it rewrites the throwing money away narrative. Imagine you're deciding between renting at $2,000 a month or buying a $400,000 home with 20% down $80,000 up front. That's $80,000 that exits your investment account or savings. Option 1, you rent. That $2,000 pays for shelter and nothing else. No equity, no asset. But your $80,000 stays invested in a diversified stock index fund. Historically, the U.S. stock market returns around 8% annually after inflation. Example math: 80,000 growing at 8% becomes roughly 172,000 after 10 years. 247,000 after 15. Compounding does heavy lifting when you leave money alone. Option 2, you buy. Your mortgage payment is around $2,500 monthly at current rates, 6% interest on $320,000 borrowed. But that payment splits 4 ways. Interest to the bank takes roughly $1,600 in month 1. Property taxes eat $300. Homeowners insurance another $150. The remaining $450 goes toward principal, actual equity. That's 18% of your check building ownership. 82% covers the cost of borrowing and local government services. Your $80,000 down payment immediately converts to equity, but it's now frozen in walls and roof shingles, growing only as fast as your local housing market appreciates, historically around 3 to 4% annually after inflation. Example math: 400,000 appreciating at 3% becomes 523,000 after 10 years. Subtract the original 80,000 you put in, and your equity gain from appreciation alone is 43,000. Meanwhile, you've been paying down principal slowly. After 10 years of payments, You've converted maybe another 90,000 in mortgage checks into ownership. Total equity position, 170,000. Your stock portfolio in the renting scenario, 172,000. Nearly identical, except the renter kept liquidity and avoided maintenance bills. Cap rate flips the lens to ask, does this house generate enough return to justify parking money in it? Investors use cap rate to compare real estate against treasury bonds or corporate debt. If you buy that $400,000 house, a landlord could rent it for around $2,000 monthly, $24,000 annually, in many markets. 24,000 divided by 400,000 equals 0.06, or 6%. But that's gross cap rate. Subtract property taxes at 1.5% of value per year, insurance at 0.4%, and maintenance reserves at 1%, and your net cap rate drops to 3.1%. Meanwhile, a 10-year treasury bond might yield 4.2% with zero maintenance calls and full liquidity. The house has to appreciate, gain value over time, to make up that gap. If it doesn't, you're earning less than a government bond while also fixing water heaters and mowing lawns. Time horizon decides whether transaction costs and slow equity buildup kill your returns. Buying a house triggers immediate friction. Closing costs run 2 to 5% of purchase price, $8,000 to $20,000 on a $400,000 home. Appraisal fees, title insurance, origination points, escrow setups. Selling triggers more friction. Realtor commissions eat 6% of sale price, title fees add another 0.5%, and if you sell fast, you might cover a buyer's closing costs too. Example math. Sell that $400,000 house after 3 years for $450,000. Sounds like $50,000 profit. Subtract 6% realtor commission, $27,000, and closing costs on both ends, $15,000 more. You've now spent $42,000 in transaction overhead, leaving $8,000 gross gain. But you've been paying mortgage interest those 3 years, around $57,000 total. And property taxes, $18,000. That's not profit. That's $75,000 in costs against $8,000 appreciation. You're deep underwater compared to renting and investing. Stretch the timeline to 15 years, and the picture inverts. Appreciation compounds. $400,000 at 3% becomes $623,000. Transaction costs stay fixed, still $42,000 to buy and sell, but now they're a smaller percentage of total gain. Your mortgage balance has dropped by $200,000 through principal payments, and if you locked in a low rate years ago, your monthly shelter cost is frozen while rents around you climbed. The renter who invested that down payment has more liquid wealth, but the homeowner has leveraged appreciation, 3% gains on $400,000 of house, not just $80,000 of cash, and potentially a paid-off asset generating zero monthly cost. 3 big confusions dominate this debate. First, mortgage payments build equity, rent doesn't. True for principal, false for interest. In a typical 30-year mortgage, the first half of your loan term sends more money to interest than principal. Year 5, you've paid $70,000 in interest, $30,000 in principal. That $70,000 vanished exactly like rent. Second, real estate always goes up. National averages show 3 to 4% after inflation, but metros like Detroit or post-bubble Phoenix saw 15-year flat or negative stretches. Averages hide local reality. Third, buying is cheaper because you're not paying a landlord's profit. Landlords pay mortgage interest, property taxes, insurance, maintenance, vacancy losses, and property management fees. If cap rates sit near bond yields, there's barely profit margin left. You're not avoiding costs by owning. You're choosing to manage them yourself instead of outsourcing to a landlord. The clean math breaks in expensive coastal cities where rent-to-price ratios distort. A $1.5 million San Francisco condo renting for $3,000 monthly has a 2.4% gross cap rate, lousy by pure return standards, but buyers bet on perpetual appreciation and lifestyle access. It's speculation layered onto housing. Conversely, Midwest markets with $400,000 houses renting for $2,500 monthly hit 6.25% cap rates, making buy-to-rent math attractive even before appreciation. Another wrinkle: leverage amplifies gains and losses. Borrowing $320,000 to control a $400,000 asset means a 3% price gain yields 15% return on your $80,000 down payment. But a 3% drop wipes out $12,000 of your equity. Leverage cuts both ways. Finally, tax treatment muddles comparison. Mortgage interest deductions, capital gains exclusions on primary residences, and property tax caps in some states create subsidies that shift the equation depending on income bracket. Rent versus buy isn't a morality tale about responsibility or wealth-building virtue. It's a three-variable equation. Opportunity cost asks what else your down payment could earn if it stayed liquid. Cap rate asks whether the property generates competitive returns before appreciation. Time horizon asks whether you'll stay long enough for equity accumulation and compound appreciation to overcome transaction friction. The answer changes with interest rates, local market conditions, personal mobility, and alternative investment returns. No version is universally smarter. One might win for your zip code and timeline, the other might win for your neighbors.